Welcome to the Stock Market Palantir. Today we are going to talk about Riot, Riot Platforms, Inc. It's a name that has been getting a lot of attention lately. As a key vertically integrated player in Bitcoin mining and digital infrastructure, the story around the company is, well, it's getting more and more complex.
It really is. And that complexity, especially its corporate history, is crucial because it absolutely shapes how investors see it today. I mean, when we look at Riot, the real question is the narrative defined by its, impressive recent operational growth, things like its Arcot power strategy and the huge Corsina facility, or is it still fundamentally held back by its history? The governance issues, the constant equity dilution, and some, let's say, limiting market dynamics.
And that tension is exactly what we need to dig into, that conflict between operational excellence and these structural challenges. I'm going to argue that RIO has successfully matured. It's moved past its speculative roots and is now a sophisticated, de-risked energy operator with some very clear catalyst on the horizon.
Okay, and I'll be arguing that despite those operational wins, which are visible, I grant you that, the underlying problems, the constant dilution, the governance discount from its past, and what I see as price suppression in its trading, fundamentally limit the long-term value for shareholders.
All right, so let's ground this in the evidence. Let's talk maturation. In Q3 2025, Riot reported record revenue of $180.2 million. That is a phenomenal 112% year-over-year growth. I mean, that scale, that trajectory, it shows real industrial execution. This is not some high-risk microcap anymore. And the key factor here, the thing that drives their resilience, is the ERKT power strategy. For anyone who isn't familiar, they are deeply integrated with ERKT, the Texas electrical grid. This lets them act as a virtual power plant. They can hedge volatility by selling pre-purchase power back to the grid when demand spikes. So when mining might be less profitable, these power credits kick in. We saw them increase by 147% year over year in Q3. That stabilizes cash flow right when you need it most.
Right, and I absolutely recognize the sophistication of that ERCOT hedge. It is a genuine operational advantage, there's no question. However, those operational metrics, they are purchased at a very steep cost, and that cost is frequently paid by existing shareholders through constant capital raises.
Well, let's talk about where that capital is going. We have to look forward to the Corsicana facility. This is a 1 gigawatt development. For perspective, that's like doubling their entire historical capacity. And management has been very explicit that the initial capacity, 112 megawatts, is being pivoted toward high-performance computing, or HPC.
The AI play.
The AI play, exactly. This is not just about mining anymore. Analysts are already talking about this triggering a massive multiple expansion, shifting RIOT from a, 5 to 10 times EBITDA miner valuation to a 20 to 25 times EBITDA data center valuation. The promise of that alone is transformative. And finally, you can't argue with the fortress balance sheet. They have $330.7 million in cash and over 19,000 Bitcoin. That's about $2.2 billion as of September. This is what let them avoid the debt trap that bankrupted their competitors back in 2022.
I agree that avoiding debt was prudent, but let's be very clear about how that balance sheet was built. My position rests heavily on this lingering, let's call it a governance discount. We can't just ignore the company's history. This entity grew out of an axis, and that involved some pretty radical pivots, including a 1-for-8 reverse stock split in 2016 just to save its NASDAQ listing. That move created a very vulnerable, low-float environment. And then there was that anomalous $9.6 million special cash dividend in 2017, just days before they pivoted into an incredibly capital-intensive business. It depleted nearly 63% of their liquidity. Now, management has professionalized since then, I get that, but that history, it's still priced into the risk models. But the primary issue today is the at-the-market, or ATM, dilution program. They have a $750 million offering registered. This lets them just continuously sell new shares into the market.
The share count went from 344 million to over 371 million in 2025 alone. That creates this persistent supply overhang. The market has to absorb millions of new shares every single quarter, and that just puts a ceiling on the price.
I see why you emphasize that. But let me offer a different perspective on the ATM. I think it's a rational financial arbitrage. They're issuing equity at high multiples, price to book over 1.5, to buy productive assets, new miners, that generate an appreciating asset, Bitcoin. They are sacrificing short-term EPS, sure, but they're ensuring long-term survival without debt. That is exactly what separates them from the pack.
That's a compelling argument for stability, I'll grant you that. But at what cost to the share price now? That supply overhang you just mentioned is real. It means the market is constantly absorbing new shares. It dampens any upward momentum, and it's probably the main reason the stock has so often lagged the performance of Bitcoin itself. And that just fuels the governance concerns we saw with that shocking say-on-pay failure. Investors are signaling they don't like how the capital's being raised.
But I think the more sophisticated capital is looking right past that and focusing on Corsicana. The scale of that 1 gigawatt project, the signaling toward HPC and AI, these are massive forward-looking catalysts. And analysts see it, citizens initiated coverage suggesting, 92% upside based on this transition? And we're already seeing the start of it, $19.1 million in engineering revenue from ESS Metron in Q3. This proves they are fundamentally shifting their business model.
I'm just not convinced by that line of reasoning, because it all relies on hypothetical execution. You're asking us to value them based on what they might become. The company is already trading at an aggressive PE of around 41 and a price to book of 1.5. That's a premium. That premium is already priced in based on the potential of Corsicana. So aren't you just swapping one commodity risk, Bitcoin's price, for another, which is successfully signing hyperscale AI tenants in a brutally competitive market? If they fail to do that, the stock instantly reverts to a minor multiple. And we also have to talk about something external, the market microstructure. This isn't about management, it's about the trading environment. Data shows over 50% of Riot's daily volume happens off-exchange in dark pools. For clarity, those are private forums for institutional orders. This suggests that a lot of the retail buying pressure, the buy the dip crowd, is being intercepted and internalized by wholesalers. It sequesters huge amounts of buying volume away from the public exchange, and that can really dampen true price discovery and momentum.
That's a really interesting point on the mechanism of trading, but I would frame the implication of it differently. You're pointing to off-exchange volume, but we also have to look at short volume and fails to deliver, or FTDs. We see high short volume ratios, often over 50%, combined with significant FTDs, like 233,000 shares failed to deliver on October 22nd. That suggests intense liquidity strain for market makers.
Okay.
Now, the cost to borrow the stock is low, so a violent game-style short squeeze is unlikely. But the accumulation of these FTDs creates a forced buying obligation. The T+35 closeout cycle seems to correlate with periods of volatility, suggesting that large institutions are watching these flows and are quietly accumulating on the dips. They're providing a floor, even if it doesn't show up in a big price spike. But let's bring it back to operational reality, because that's the baseline. Even with the rising cost to mine Bitcoin, the ERCOT power credits are a brilliant hedge that is not correlated to the crypto market. Riot stabilizes cash flow by selling power back to the grid at a premium. They are literally generating high-margin revenue when their competitors are getting crushed by energy costs. It's a unique differentiator.
And I come at that reality from a different angle. That 30.9% increase in their unit cost to mine, up to $46,324. It means their business is now critically levered to a very high Bitcoin price to justify that premium valuation. And that cost increase is driven by the 52% global hash rate surge. That's competition. If Bitcoin doesn't stay above, say, the $90,000 level needed for profitability after the halving, those power credits alone just cannot offset the margin compression. The ERCOT hedge is great for the energy part of the equation, but it doesn't solve the fundamental unit economics problem.
Look, Riot Platforms has clearly moved past its speculative roots. The narrative today is about industrial execution. It's about leveraging its unique power infrastructure in Texas and the massive upside of the Corsicana HPC pivot. The stock's future, I believe, is determined by management successfully transitioning this company from just a crypto miner to a diversified energy and data center company.
And I would say that while operations have professionalized, investors have to weigh the real-time cost of that growth. The structural factors, the persistent dilution, the lingering governance risks, and a complex market structure that potentially holds the price down, it all means the stock will likely face a slow, challenging grind higher. Its success is contingent on more than just Bitcoin's price. It depends on fixing shareholder misalignment and delivering flawlessly in the hyper-competitive HPC market.
So we've really explored the tension here between Riot's clear industrial growth, the Corsicana catalyst, and its ongoing struggle with dilution and these microstructure dynamics. The whole analysis really demands attention to both the financial metrics and the very intricate details of how the stock trades.
Right. And the crucial question remains whether that institutional accumulation you mentioned and the eventual success of the HPC pivot can ultimately overcome the structural drag from this constant supply overhang.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights and see you in the next video.